Hi, as the famous forecaster Yogi Berra said, when you see a fork in the road, take it. Now, why do I repeat his saying? Because right now, the market is in a real fork. A week ago, everyone was super optimistic and the market flew up. Then Friday, everyone became super pessimistic and the market got smooshed. That's a real fork. What to do? My opinion is take both sides of the fork. First the one up, then the one down. And yes, the first time is the one up. Still. Now, you should of course take my views with a grain of salt, but I think the market soon will soar again, for longer than most people think, then it will crash far deeper than most believe. What do I base it on? It is based on my sleuthing, on some reliable indicators, and on some historical analogies. So let me give you first my reasoning, then my longer term outlook. Short term. As you may or may not know, OPM runners, those who run other people's money, are 90% of the buyers and sellers in the stock market. And as you probably don't know, almost none of them has sole buy and sell authority. Almost all buying and selling is done via committees. How do these investment committees make decisions? It is mostly done via group consensus. And as smart as committee members are, their views are based on what the members read and hear, that is, on print and screen, and in phone calls with others like them in brokers' offices. Yes, 99% act on hearsay, audited, vetted, but hearsay. Only 1 in 1,000 does anything which is original physical sleuthing, that is, go out of the office and sleuth companies physically, like I and others like me do. Very few do. So when committees act, they all act together based on the consensus view. This is well known. But what is less known is that what the committee members are paid for is doing better than the market, whichever market they are judged against. The S&P 500, the Russell 2000, the Nasdaq, a combination of several. This is called the benchmark. And what is this market? It is, of course, the combined results of all OPM runners' actions. Therefore, by definition, OPMs are paid for being better than average of all OPM runners. You therefore think that half of OPM runners do worse than the market and half do better, right? Wrong. Only 10% of all OPM runners do better, while full 90% or more do worse. 1 out of 10 at best outperforms, with 9 or more doing worse. Why so many laggards? Because OPM runners are paid between 1 to 1.5% of the AUM, asset under management, and on top, there are trading expenses, say another 0.5% per year. So in effect, a typical OPM runner, a mutual fund manager or a pension fund manager or a committee, has to perform 2% more than the market per year, or as it's called, 200 basis points above the market, bips, also known as bips, just to match the market's performance. Very, very few do. And what if he or she doesn't? Then he or she gets fired. Maybe not the same month or the same quarter, but certainly in a year or two. Therefore, the OPM money running business is a dangerous game. 10 enter the killing arena, only 1 leaves. As bad as that? Yes. Just a few weeks ago on Bay Street, a whole raft of almost 20 money managers were let go from one company. Why? Because they underperformed the market for a while. So many of the clients began to say, why do I need you when I can just buy a market index fund with a skinny fee? It'll do better than you did in your committee. What did the remaining OPM runners do? They apologized and took more clients to lunch. And what did the fired ones do? Most stopped being money runners, also known as portfolio managers, and became analysts that write reports that help the committees to make buy and sell decisions. Yes, if the portfolio manager outperforms the market, which only 1 in 10 do, he or she gets paid well. But the sword of losing clients and being fired by underperforming is always on their necks. Now, why am I telling you all this sad story? Because when the market runs up, it often runs up with only 1 out of 10 OPM runners outperforming it, and 9 out of 10 doing worse. And why do the other 9 do worse? For 3 main reasons. First, because they had bought the stocks everyone else is buying by consensus. So how can they do better? But second, they are not allowed to buy too much of any stock, even the good ones, at most say 2 or 3% of each. And when the stock doubles, say, they have to sell some of it, sometimes half of it, just to be safe. So how can they outperform? As Peter Lynch, who was a good OPM runner, said, they cut off the roses and let the weeds grow. In other words, it's as if a boxer had to pull all his punches, yet be expected to win in a knockout. Okay, that's two reasons. But the third and offers the most important reason is that because when stocks are cheap and the index is low, OPM runners are scared, just like everyone else. Remember? It's a consensus. And so they keep too much cash in their portfolio, and so they leg the market. Just like since last April, when the market was at the bottom, when I told you, remember? Panic was in the air, so OPM runners had very little stocks in the portfolio and lots of cash. But then, as the market rose, the laggards, 9 out of 10, had to scramble and buy more stocks, which caused the market to go up on a spike like the last few weeks. Then they all became optimistic because they thought they're finally safe, but then the Iran war broke out, and Trump said something, and then the market tanked. And 9 out of 10 OPM runners became despondent, just like last week, and many sold. Or the committees became fearful and sold. Okay, you say. So why do I think the market will still go up soon after the last week's smash and go up a lot? Because OPM runners still have lots of cash in their portfolios. And the fear and greed index and other such reverse indicators show OPM runners are still scared. But most of all, a few stocks, especially some cyclicals they follow, which have a fairly precise cycle length and fairly predictable tops and bottoms, are still way off their bottoms, but are still well below the cyclical peaks. Like which stocks? Or like Albemarle, ALB, or Huntington, HUN, which I pointed out to you about 90 or 100% ago, but which still have 100% or 150% upside even now. Yes, as do some other stocks I follow. But yes, just my opinion. Yes, just my opinion. So that's the first two reasons. OPM panic and committee decision making, and some reliable stock cycles. But that's not all. On top, there's now a general craziness in so-called AI stocks, which have only gone halfway insane, like internet stocks did in 1999, before reaching their peak in 2000. And so the stocks today have a way to go before they'll implode, in my opinion. In sum, once AI stocks go fully insane, the S&P 500, which contains many stocks that are infected by the AI craziness, can go from the current 77,500 to about 9,500 or 10,000, which is 33% higher than here, before the market gets smooshed, in my opinion. Yes, like 1999 leading to 2000. Okay, you say, but why do you think AI today is only half insane? And why do you think it'll go fully insane before it gets smooshed? For this, you really have to know AI. Not just read about it, but really know it, and you need to have done it to understand it. I told you most of this before, but here it is again in brief. AI is a great technology, yes, very useful, and won the Nobel Prize twice. But I have been playing with it since the early 90s, which is more than 30 years ago. I audited some of the classes of Jeff Hinton in the U of T, who invented backpropagation of the neural network, which is the first name of AI, after a guy named Marvin Minsky, by mistake, delayed the technology by 30 years via something called the perceptron. But I digress. The short summary is that, in my opinion, AI today is an overhyped development whose investment distort the economy insanely on 3 levels. First, unlike your brain and mind that train on physical reality and run on 22 watts and a cup of coffee, modern AI, also known as neural net or LLM, large language networks, is trained on reflections of reality, also known as data, needing bazillions of megawatts to train on and bazillions of data bits. Therefore, to train these so-called AIs today, many companies today invest in data centers and nuclear fusion to generate electricity, which cost bazillions of dollars, all of which spill into soaring stocks which OPM committees must buy to keep their jobs and outperform the market. But second, because the so-called AI today stops learning once it's trained, it doesn't accept new facts which contradict what it was trained on and locked. You and I, keep learning even after we finish school and got our degrees. and we change our opinion, we're faced with new facts. Today's AI cannot do this. Ask it, it will confirm this. AI biases are forever. But third and worst, because of the above, current AI doesn't learn from mistakes, which I, and I hope you, can and do. See the work of Jan LeCun, who was chief of AI in Google before he went on his own and raised $1 billion to do real AI that does learn physically and learn from mistakes. And now we get to the crux of it. Once this new kind of AI comes in, like Apple first made the first PCs, the current AI industry, data center and electricity generators will get smashed, like Apple's PC smashed IBM mainframe as these became redundant, which brings me to the market smash. In my opinion, once the S&P goes to 10,000 plus or minus, something will happen. Reality will set in like it did in 2000 after the internet craze reached its peak, and the market will start going down in waves like it did in 2000 until 2003. How far will the S&P 500 go now? My call is between 80 and 85%. In 2000, remember, in the internet craze, the Nasdaq fell 90%. And why these awful declines? Here are two reasons. The first is 1929 as a parallel. At that time, the yield curve stayed negative for 23 months, the second longest in history, before it turned positive again. So about 6 months later, after it turned positive, the famous crash occurred. Why does the yield curve matter? Because the negative yield curve caused the economy to become very fragile, and it always precedes a recession, always. And it also always precedes a market decline, always. And most important, the longest the yield curve stays negative, the deeper the following market decline. After the 23 months negative yield curve of 1928-29 came the 90% market crash of 1929. But why did I say the second longest? Because the longest negative yield curve in history was recent, in 2024 to 2025, and it lasted 26 months, ending in Q1 2025, about a year and a bit ago, which means we are due now for a market crash equivalent to 1929. But in my opinion, we must first see a crazy market spike, like in 1929, following the radio and railroad stocks craze and overbuilding, or like the one in 1999, due to the internet stock madness. The parallel craziness today is the AI and data center and electricity stocks insanity, overbuilt like railroads and the internet were. And once the crash comes, its decline, in my opinion, will be of a similar level as the 1929 Dow crash and the 2000-2003 Nasdaq crash. What will happen afterwards? By that time, obviously, all the world's Federal Reserve boards will print money, but not just to save the Western economy, but also, and this is something that you probably hear for the first time, not elsewhere, to save China too, which is the world factory in effect. China, you see, is already bankrupt, getting bankrupted by the day with debt of 350% of GDP. It's being kept afloat only with fumes and lies and desperation. Therefore, in the coming crash, in my opinion, China will almost go under, but will be saved for one more cycle. And in my opinion, will go completely under by the 2030s, by which time, like East Germany, it will go bankrupt and be sold in pieces in a Treuhand, a bankruptcy trust, like East Germany was. Because again, like East Germany, or like the Ottoman Empire in 1875, it could no longer afford sovereignty. But that's another story for another market fork in the future. As for now, let's focus on the current fork. In my opinion, a soaring spike up first, then at its end, the beginning of an 80 to 90% crash in waves. How long until the coming peak? Don't take my word for it, but my cyclical stock indicators tell me that it may probably come only in 1927, if I go by their average cycle length and average peak-to-peak growth rate. But of course, both I and my indicators could be wrong. So do your own sleuthing, as you can learn to do from my books, The Sleuth Investor and The Advanced Sleuth Investor, which you can buy on Amazon. And I hope after reading them, you can write reviews on them, which I hope will be good ones. I'll see you next time. And meantime, thank you very much for watching.